Have you ever approached your parents for a loan? You probably have. You probably said, can you give me a gift? Have you ever approached your parents for the reason why they brought you into this world? Well, maybe not, but what if you're a parent and you've got kids that you want to help out? There's a question we're going to talk about today about someone who wanted to gift money to their kids, and hearing all the podcasts, hearing all the things, they get a bit overwhelmed. Is this the right thing? Is this the wrong thing? And I basically chimed in and was like, hey, you're allowed to do nice things for your kids. If you want, you can do that. So we're going to talk about that today. I've also got a guest, Phil Thompson. He's a friend of the show, friend of mine.
You don't need to nod your head a little bit.
Yeah, he's a friend of the show. And I'm in Melbourne, so I thought, let's do an episode. Let's talk about stuff because, Phil, you are a financial advisor. You
Guilty.
Only do insurance for a lot of our listeners. Do your own bloody shout out or sponsorship pitch. So I don't want to read. Sell yourself.
All right. So I work at Sky Wealth. We help people set up personal insurance. And yeah, we help a lot of community members out when they decide, you know what, I've bought a house, got this massive mortgage, I need to protect it. So we help income protection, life insurance, disability, trauma, all of the personal insurance covers is what we do.
Awesome.
But today we're going to be talking about some of these questions.
We really are. So thank you to Sky Wealth for supporting the podcast. Thank you to you, Phil, and your team for helping all our listeners. My name's Glen James. Let's get it on. So Michael in the Facebook group said, my daughter needs to replace her car but doesn't have enough money. We have the means to help, and everything I read and listen to say that the best way is to set up a formal loan with her. Has anyone done this, and how did you come up with the paperwork? I've also heard this helps protect them from a partner claiming half if we just give her the money. Now, I'm assuming the daughter is potentially early 20s, late teens. I'm also assuming, well, I'm not assuming.
Non-married.
I know. Well, he said that she doesn't have a partner at the moment.
Oh, right. Okay.
And he also said about 10K.
Yep.
So you've got 3 daughters.
Yeah, I do.
When it comes to cars, for example, how are you negotiating this, or how are you negotiating life as a dad with daughters, number one, but more so if one of the children needs something like a car when they're 18, how are you doing it?
Yeah, so we've got 13, 11 and 10, so they're not there yet. I don't know. I'm, to be honest, a big believer in our kids doing hard things. And this is my view today, I don't know if when my daughters are in that situation where they need these things and we do have the means, will I help them? But I'm a big believer in just going like, how do we teach our kids to plan ahead? Like, we know that we're going to have to replace a car in the future. So start saving a little bit today to plan ahead for when that happens. Or make them catch the train for a little bit. And it depends on where we live and you know, what is the reality. Because if it's me driving the kids to work and then to school and uni and all that stuff, then it's a bigger impact. So I'm a little bit more harsh in going, I think in Australia, we're all really spoiled and we've all got so many choices. Artificially constraining ourselves to get through it is something that I'm keen on doing. You
evil dad.
Exactly, yeah.
But also you're a tight ass.
Yeah, but I do think that I do think a lot about how do I teach my daughters to live in the world and on their own terms. So even if I had the means and the desires, and you know, I don't actually have a concern doing that. It's not being a tight ass not doing it, but I just think about what are we teaching them? Because if they can't save for a car, how are they going to save for a house?
Yes. However, and full disclosure, I don't have any children that I know of.
Yes.
I just love that comical line in there.
Yeah.
But I'm thinking, just from my position behind the desk when I've dealt with clients over the years who have kids in this situation, because I said to Michael in the Facebook group, it's like, you're allowed to do nice things.
Yes.
And so my whole kind of vibe with this question is, Michael's daughter, she could be studying full-time at uni. She could be catching the train to and from uni.
Yeah.
She could be working a part-time job and just totally grinding relative to the situation.
Yes.
And if the daughter doesn't have afterpay bills, if the daughter is managing their money,
Yes.
if the daughter is contributing, if the daughter lives at home and is a good household citizen and all that, if Michael has 10 grand that he wants to give to his daughter because he loves her and he can see that she's putting the hustle in, she's got her head screwed on, I want to do this for you.
Yes.
Here is a car. It's the difference between, Dad, give me a car, I'm a spoiled brat,
Exactly.
I live loose and all that.
And it's around the intention of the daughter.
Yes.
Yeah, what is the intention of the daughter is what I would think a lot about. And am I creating an artificial comfort zone for my kids by, and I guess it's more, if they came to me and said, Dad, can I have a car? And I'd be like, well, I've got the money, I can. I would probably question, well, go and earn the money and buy your own car.
I'm a big fan.
But if it was that situation where they were working hard and they didn't have an expectation of a car and I had the finances and I wanted to bless them, then, I would consider buying the car.
Yeah. And also, because every situation is different,
Yes.
I'm a big fan of, as they are in their teens, and who knows, this could be their second car. They may have saved that first $8,000 one and it crapped itself and
Yes.
it's not worth putting $2,000 in.
Yes.
So there's that as well.
Yeah, exactly.
I like the strategy with teens and kids. If you save up for a car when you are old enough to get one, we will match what you save up to $5,000 or $10,000. So save $5,000, here's another $5,000, go buy a $10,000 car.
Yeah.
But I think it's that whole, are they a spoilt brat to start with? Are they contributed to the house? Are they working or studying? And you have the money.
Yes, and that's right. And we live comfortably in our household. Our kids, we're not extravagant, but we live comfortably. And so I just think about how do we make sure we just are empowering our girls to understand. And one thing that we've actually changed at the moment is we give them pocket money on a regular basis and they will buy everything on their own. So they're starting to go, how do I save for this? And they can go, our middle went to La Vista, which is like a kid's jewelry store.
Isn't it La Visa?
Oh, La Visa. Yeah, you're right. Yeah.
Gosh, Phil, get it together.
I just saw the jewelry. We just did a fashion show at home, but and bought like 7 items, and it was like, great, they're awesome. That's something that you're passionate about. But if you want to go to the movies or something, you're going to run out of money. So it's helping them exercise that muscle of saving and being aware of their money. Because in the past it was like, Mum, can I just have money for this? And it's like, well, no, we have to teach them that it's, we've got to be responsible. So again, back to Michael's point, it really depends on the attitude and the atmosphere and the environment that you're creating. That's the thing I think about. But in terms of like how to actually structure it, I mean, you can talk to...
Yeah, so I think I see this as they're a good kid, sure, help him out, give him $10,000 for a car because he's got the means and all that.
Let's
assume that.
Yeah, easy.
So in terms of the loan, and this is why I said this goes against online chatter and advice, right? So let's do another scenario. Just for a moment, we'll park the $10,000 car. If you had a daughter and you had significant wealth, well, not you, but you, the listener.
Oh, yeah, sorry.
If you had a child, you had significant wealth, they weren't married, they weren't in a relationship at all, and you were like, hey, we want to help you get into a first home. Here is $100,000, here is $300,000, but we're going to structure that as a loan. So a couple of reasons there. If it is a loan, that loan has a formal document. It's in place. So if there is a relationship that breaks down and the assets get split, or the property assets, so in family law court and all that, they call it property assets, which could be a house, could be shares, could be cars, could be cash. The property assets get split. Before the split, the loan gets paid back.
Yeah.
Okay. So there is some protection there. So what you need to realize with the loans to children, it can impact a couple of things. Number one, speak with your mortgage broker, because depending on the bank or lender, they may not take that into consideration if it's a loan and not a gift. So it's here's a non-refundable gift. Awesome. Here is a loan. Well, you have to pay it back next week. It's a liability. So all of that stuff.
Yeah. So the daughter needs to talk to a broker,
Yes.
or Michael.
The daughter or the son in this property situation. The child should talk with their broker or both of them together because they're involved because we want to protect this asset. Another way to protect the asset is obviously the parent to own the $300,000 or $100,000 portion of the house. Clearly an easy way to do that. So you need to speak to your broker on that. Another thing you need to realise when you are loaning money to children or anyone really, loan agreements are generally state-based and they need to have some type of activity or repayment, or there's a dollar being repaid within the 3 to 6 year window. I think Northern Territory is 3 years, the statutory thing. I think New South Wales, it might be 5 to, anyway, check. I'm just saying it's state-based. So what you need to do is you would 100% go to a lawyer and pay $1,500 to get a formal loan agreement drawn up if you are loaning money to your children for the protection from that wealth.
As in the example of several $100,000 for a house?
Yes.
Okay.
So, and this is where we're going to get to the $10,000 amount in a minute. Within that loan document, and that's why you need to talk to the broker. Will the bank accept a loan or do they need a gift?
Yep.
Then what you need to do is talk to the lawyer. Within the loan documents, you need different mechanisms that the loan has to be repaid if the house gets sold for whatever reason, if there is a relationship breakdown for whatever reason, if Mercury is in retrograde or whatever the thing is for any reason. So you put all these terms and conditions in. It's to be paid back within the state-based legislation. You may have to show that they've actually paid $1 or an amount during that yearly term. And then at the end of the term, there's a thing in the loan agreement that there's a new agreement that's created and all that stuff.
Yep.
Okay. So that's a really good way to protect the asset if your child goes into a relationship breakdown. And similarly, it would probably, I'll go out and on a limb, it would probably be the same way and be protected potentially if the child racked up a heap of debt, went bankrupt, but they did have some assets and all that. So I guess that's a very outlier thing. So there could be protections there. But when it comes back to a $10,000 loan for a car,
am I spending $1,500
you're not.
on a legal agreement? Yeah.
You're not. You can, but you're not.
Yeah. Most aren't doing it for the $300,000 gift. So if they're not doing that, they're not doing it for 10 grand.
But with the car thing, we know it's in the daughter's name. So it's hers. If you wanted to, you could keep it in your name and let them have it and drive it around forevermore. Amen.
Yeah.
So, but if the daughter in Michael's situation got into a relationship, it did go sour, the partner's coming after half the car because it's his and they've been living together for 18 months and it's a de facto relationship and half that car is his and all that stuff. Okay, well, the car's probably not worth 10 grand then. It's probably worth 7, might be worth less. Yeah. What are we doing here? So I think that's a good way to frame the conversation. Your judgment, what's relative in your world. If it's a $300,000 gift and you're worth $10 billion, you're probably not worrying.
Yeah, yeah.
If it's a $10,000 gift, let's just help our child.
Yeah, and you know, depending on the whole situation, maybe it is just as simple as you buy a car, you put it in your name, and you let your daughter use it, and it's effectively there. Is there any downside risk on that?
It's just more some practical issues. If speeding camera, the fine's going to the car
and then
owner.
They've got to sign off to
if there is an accident and something really terrible happens, might be a good thing that they're going to the registered owner's place, which is the parents anyway. Yeah. There could be some issues if the parents, this is an outlier, are on age pension at over age 67. The gifting limits would come in 30 grand over 5 years. Yeah. So you'd probably maybe buy a car and let them use it rather than give them money.
Yeah, that's the pro for owning it in your name.
So I don't know. I think in this situation, and every situation that we talk about on this podcast, there's a million scenarios.
Yeah.
And we've just spent, looking over at the time, best part of 15 minutes, or 10 to 15 minutes or whatever, talking about this one thing, which is awesome because we can get into the details and nerd out a bit.
And that's why it just goes to show how individualized all of these decisions are. Your relationship with your daughter has a massive impact.
Yeah. And that's the whole thing with this, my overarching comment. Michael is engaged with the podcast. I think it is you, Michael, that we've tried to do a Retire Right podcast episode with him because him and his wife, I think, have retired early.
Great.
They've built a business up or something like that, come into some money, life's good. They're in their 50s. So I'm thinking daughter 20s maybe-ish.
Yep.
So all this stuff, I just think, and he's engaged, he's like, hang on, I've heard on podcasts like this that need to be careful with loaning money and protection and all that, which is absolutely correct. But I don't know how this saying plays out, but it's something to do with the forest and the trees and something like that. It was like, let's just step back, small amount of money. If you want to do it, do it. If you don't, don't. Simple as that.
Yep.
And there could be some, if you own it and they're a nominated driver, could be some different things with the insurance as well. So one of those things. Can't wreck it. All right, Philly.
Yes, Glenny.
This question here, I was actually going to tag you in the Facebook group, but I didn't because I don't think you're on there much anymore, are you?
I am, but I try not to get on Facebook that much. I try and be present with my family.
I wouldn't have Facebook if it wasn't for our Facebook group.
Yeah.
But it's our kind of where I get the finger on the pulse for everything that we do here. This one is for you. Silly question alert.
Hey, you know what?
But here we are.
The only
Tell
silly
me.
question is the one that's not asked.
Thanks, Dad. Is it worth having life and TPD insurance if I plan on moving overseas in a year or two and not coming back?
Well, the answer is yes. There are a few factors. So when it comes to like applying for the cover, the insurance company will ask, all insurance companies ask, do you have intention to go overseas in the next 12 months? So if you don't have any hard plans and you're like, maybe in 2 years and maybe I'll never come back.
Are they saying within the next 12 months or is it just intentions at all?
No, 12 months.
Okay,
yeah,
that's
normally
good.
it's 12 months. And so not coming back is an interesting thing. If you're legitimately going to migrate to another country, then does it make sense to have an Australian bank account, pay those premiums, or to have your Australian super fund pay those premiums? And so if you have no intention of coming back, then maybe it's not worth having it. If it's a maybe I will, maybe I won't, then it may be worth setting it up. But just like our point before, it's all individualized. It depends on what country you're going to. Because if this person's saying, I'm going to the UK, they've got great insurance companies in the UK and you're planning on living there for the rest of your life, set it up over there.
Yeah, I would probably disagree with the insurance god across the table from me. But I want to ask you a couple of questions and maybe you can answer it after. Do you have companies that would insure people that live in Australia at the moment who are moving overseas temporarily or permanently?
Yeah, it is much harder.
Okay.
So
is it, as Ralph Wiggums would say, impossible?
I actually don't even know what that question is. I know Ralph Wiggins, but what's
Me fail English, that's impossible.
As in meaning it is possible or
not
not possible?
possible.
Okay, got it.
Yeah.
It is difficult. So if you have any intention to live abroad in the next 12 months, most insurers will say no. Now, one thing that we've done at Sky is there's like, I think 400,000 expats living abroad.
Wow.
Aussies living overseas, either in the Middle East or in the UK or in the US. And so what we did is we've got some great partners who work exclusively in that space, and they've come to us and said, we can't get insurance for our overseas clients. Is there anything you can do? And we spent an awful amount of time trying to negotiate with an insurance company, because pre-COVID there were some policies that you could get if you lived overseas. Post-COVID, everyone just shut down shops and hadn't touched it since. So there is one insurer who will insure Aussie expats if they don't have a clear intention to return to Australia.
Right, okay.
And that's an Australian policy. There are a few terms and conditions that are different, but essentially it's the same policy that you can get in Australia. There are some other insurers who need you to have a clear intention to return back to Australia within like 2 years or 5 years.
Which could be a work contract or some other type of document.
So a lot of people like
or when the kids are starting school.
Some people have intention, like when the kids are going back to uni, we want them in Australian universities. So they have a clear intention to come back in that time, and they know that. A lot of the contracts overseas will be like 12 months renewing contracts.
Right. So they're not a guarantee renewable contract.
Well, sorry. No, the employment contracts.
Right, sure,
over there.
sure.
So,
Yes,
someone is on a contract and it just every 12 months or every 3 years, they're just rolling into another contract. And so if that's the case and they don't actually have an intention to return in the next few years, then some other insurers are excluded, but we still have one where there doesn't need to be a clear intention to return back to Australia.
Yeah, right.
But the life insurance contracts are exactly the same as what they are if you live in Australia.
Okay, so it is possible if someone was looking, like Sue here was looking, she could contact you and be like, can you help us out based on this situation?
Yeah.
Okay. So what I disagree with you on is, as far as I'm concerned with insurance, we are insuring a need.
Yes.
And so let's just use, what did Sue say? Yeah, life and TBD.
Yeah.
So Sue has a need for life and TBD. It could be we've got young family, we've got a mortgage, we've got debt, literally have a need for insurance.
Yes.
So we insure today for that need if it arises in the future.
Yeah.
Tomorrow, the next day, regardless of if your situation changes, and I think we will go overseas in 2 years and live, well, that didn't change the need overnight.
Yes.
So I think we insure the need when it is there. If it comes to in 2 years' time or a year's time, it's like 12 months down the road, yeah, we're going to do it. No, but we're going to do it in 2 years now, not another year and not right now. Awesome. The need is still there, still got young family, still got mortgage and debt.
Yeah.
And the reason why I say I would do it in Australia is because in 2 years' time, when it comes that we are moving abroad and your health had changed, you might not be insurable anymore.
Yeah.
So at least it's take the policy out now because the need's here and we just review each year.
And where did we disagree? Did I say you shouldn't take out the policy?
You're like, you probably wouldn't because you can get a policy overseas.
I could have said that. Okay. I don't think I meant to say that.
Okay, so are you saying basically insure yourself now?
Yeah.
And then when you go overseas, get a policy over there.
Yeah, that could be the option. Yeah, so get the cover today.
Yes.
Even if you're only going to hold it for 2 years, but at that point in time when you are somewhere else,
get the
decide, well, I'm in the UK, going to be here for the rest of my life, then cancel your Aussie policy and set up
after the new one is set up.
Yeah, after the new one set up. Yeah, go and set it up.
Okay.
Yeah. So, I mean, because like in the next 2 years...
But you're not setting up a level policy here or anything like that.
No,
you just get the cover, move on with your life, review it year on year.
Yes.
If the plans change, awesome, you've got insurance. If it happens sooner, awesome, you're insured. When you get settled in the new country, take up your insurance. If you're medically declined in that country, well, hey, at least we've still got $1 million in AUD that we're insured for.
Yeah, and I guess the thing that I would say is if anyone's planning on living abroad and may come back to Australia, then the answer is 100% yes. If the need is for life and TBD, get it.
Yes.
And likely maintain it.
Yes.
Until retirement. In this situation, it is get it today, but then once you're over there in a country that has good quality policies. Then move to those policies over there.
They might be moving to the armpit of the universe or something like that, where there isn't an insurer.
Yeah, and there are some countries that which you probably just wouldn't want to have those contracts domiciled there, because in Australia there's great.
There's contract protections and all that.
There's so many laws to protect, the stability of the insurance provider. So many laws in fact that it has to be renewed every year. They can't just opt out of that cover. And so that's why like Australian contracts are very, very favourable. But there are some other jurisdictions that are also very, really favourable.
Yeah, sweet. We'll be right back after this.
If you're after personal financial advice, don't get it from a podcast. If you would like help based on your own personal situation, head over to moneypodcast.com.au, click Get Help, and we'd be happy to introduce you to one of our trusted professionals. Our panel of vetted financial advisors and mortgage brokers work with people all over Australia so they can connect with you wherever you are. That's moneypodcast.com.au and click Get Help.
Okay, we are back. There's no community segment of the week, Phil, because I didn't plan to do an episode with you today in Melbourne. If you are watching on YouTube, this is Phil's studio.
Welcome.
And wasn't planning, so I forgot to let the team know to prep a community section of the week. But
Sorry, no. Let me just clarify. You did plan it and then you cancelled it and then we replanned it.
Yeah, there's technicality there in the fine print. But hey, we're here now.
Yeah, that's right. We're here. We're enjoying each other's company.
Exactly. But here is a community segment of the week question for everyone to ponder on. I got a message this morning from Kayla, who is the co-host of the This Is Business podcast that I have with her. We are rebooting that this year, everyone.
Let's go.
We're bringing it on. She sent me a message and I'm like, she said, I'm interested to know your answer to this. And I'm like, what's the context? Like, where is this from? What am I walking into? And she's like, it was in James Clear's weekly email. No context, just curious. So here's the question. You get to pick a new career based on one factor. Your job is to do the activity that most frequently puts you into a flow state. A flow state is you feel fully immersed in your work. You're in the quote-unquote zone. Time flies by without you realizing it, etc. What do you choose? I get the flow state by Ritalin now. So anything, really. What do you choose? And while you think, I'll say mine.
Yeah, go, please.
So I basically said to Kayla, I'm like, I'd probably choose doing my business now without having to host any podcasts. Like, just if there was a successful hosts of other shows and all that I didn't have to be on. So just literally running the business.
You want to run the business, not be the superstar.
I don't want to be on a podcast every week 3 times, but here I am. Because I love it. And I love dicking around with the tech in the studio as well. I like, when Shell comes in and Jess and, we've got a new show coming that's for YouTube. I love being in the studio and doing the tech stuff.
Yeah.
Have I showed you the new cover art for the new show?
No.
Don't say anything, but I'm just going to show you now.
Hot pink? Really?
You wish, Phil.
All right, let me answer the question. What will put me in my flow state?
Looks cool, eh?
Yeah, it does. Looks great.
Yeah.
I mean, I'm very fortunate. I do really, really enjoy my work. I guess I would just remove some areas of my work that I do. Like if I could never do emails ever again in my whole entire life, that will be my flow state.
Yeah.
So basically, I enjoy what I do, just minus the emails. And I'm trying to work on how do I actually manage that and build the business around the fact that I hate emails.
Yeah.
I feel like, I'm similar to you. I love most of what I do, just remove some of the pain points and happy days.
If I was a business coach, I'd be like, well, how do we remove those pain points?
And we are. We're trying to work on how do we do that as a business.
So what would you do, everyone, to get into your flow state? Just on careers, Chloe in Face Vegas asked, questions for people in the financial planning industry. That's you, Phil.
That's me.
What is the best way to get started? I am mid-aged and looking for a career change. The first thing you need to do, Chloe, is buy the book Sort Your Career Out and Make More Money. We'll start by working out what your values are. Yeah, there's a copy in Phil's studio. Love that. And it is the most underrated book out there. Sort Your Career Out and Make More Money. I like the idea of one day I can run my own business/service, as I have over 10 years experience in public sector and hated it. I have degrees and not looking to do another bachelor. would a FACEA, which is the authority that makes sure financial advisors are ethical and approved and all that, would a FACEA approved graduate diploma of financial planning get me an entry-level job? I mean, an entry-level job, you wouldn't even need all that. Just get a job in a financial advice office.
Yeah.
That's what I would say. Is Kaplan a good place to study with? Yeah, they're fine. Other similar uni-offered courses are expensive. Any recommendations is appreciated.
Yeah, I mean, it's a good question. So there's a few things in there. You want to run your own business one day. I'd love to touch on that. But in terms of just the how to get started, so you can go to Kaplan and actually provide them your current studies and what you've done in the past. So there can be like a non-related degree. So my non-related degree gave me a credit for my studies.
Sounds like a circus.
Yeah, it very much is. And so you can go to Kaplan and just say, hey, this is what I've done in the past. Can you let me know what requirements I need to do to enter into my professional year as a financial advisor? So there's that. But, you know, as you said, you don't actually need to have all that before you start an entry-level job. But you're going to take maybe you're not, but it may be fair to assume you'll take a pay cut to get into it. So it does make sense if you are earning more than that entry-level job, get your studies all done. So then you can join a financial advice business and like clearly articulate what your growth trajectory into being a financial advisor, because
I would start in client services in an advice business.
Would you do it before you finish your degree?
Yeah. Well,
even if you were earning a higher amount today?
But this is, if you were like so done with your current job and you had some savings and it was a 10 grand hole, could you plug that with something else? I don't know. Or, see, and this is the thing, I don't know if there would be a difference. So if we took the client services role, I don't think the salary would change whether you've got your FACEA approved degree or not.
True. But you could become an advisor much sooner and your income will go up.
Yeah, but I, as a consumer and dickhead with the podcast, I don't want a financial advisor who hasn't had a little bit of experience in the world, as in the financial advice world. Yeah. So that's why I would always say, just go work in client services, find out how the structure, how everything works, learn all the stuff. Within a year of being in there, set your trajectory and be like, I want to get into paraplanning or then into associate advising and do a PY and all that.
The other reason why that is good advice is because you may just not like it.
Well, that's why we talked about the values in the career book, because you might be like, I want to be a financial advisor, but you hate people, but you like analytical numbers. Yeah. You can be in the industry and...
Or like to be perfectly honest, like one thing that may be super passionate about is helping the everyday, like helping the everyday Aussie just get a bit smarter and better with their finances. Like financial advisors can often be a little bit higher in terms of the clients they work with are higher socioeconomic status. And so, if you want to work with people and do like financial coaching to help people pay out some like crippling $10,000 debt that they've got, that financial advisors are maybe not the best place to go. And maybe being a financial counselor.
Yeah, but there's no money in that if you want to make good money from your career.
Yeah.
Because financial counselling, it's borderline left of a volunteer charity role.
Yes, correct.
I'm making a big statement, but...
No, I agree, but it's more the clients you want to work with and you feel like you will work with in financial planning. Just be going into client services will help you understand the actual business.
Yes.
We had a career change, or we still have in our business, a career changer. And just this week, actually, I got on a meeting that she was doing a one-on-one with another team member. And I jumped on and I surprised her and I said, hey, Amy, how is it like being here now that you've seen how the sausage is made?
Yeah.
and like, is it better than you expected, as expected, worse than you expected? Because, this team member was a client of ours, and then, changed careers and then, is working with us and now advising or provisional advisor.
Is she liking it?
Yeah, she is. Yeah. And she was like, it was kind of as expected. There's a few things, internally, like I didn't realize how much technology the business would be using to help manage the whole thing.
Do you want to interview her within the next 4 weeks because we're a little bit ahead on this schedule.
Yeah.
And we'll put a link in the show notes to the YouTube interview with you interviewing Amy. Do you reckon you could do that?
Yeah, so we can we can work that out.
Or she can come down. She can come down to my studio.
Yeah, she can come to you.
Yeah, we'll do that.
Yeah.
Let's do that.
Yeah.
And we'll do it as a bonus YouTube only content, because Amy lives near Newcastle, and it was so funny when she first started with you. I think I was with you somewhere in Melbourne. You gave me her laptop.
Yeah.
I took her laptop, and she's like, "Oh, can I come and get it?" I'm like, "Yeah, I'll be at my boat working on it." It's out the back of a storage facility that looks like they're about to shoot a murder mystery thing in a scrapyard in Mayfield. Yeah, come down. Anyway, it's so dodgy. I'm like, "Hey, I'm Glen. Welcome to the scene of weirdness."
Yeah.
Anyway, so that's what I met her.
She's still alive.
Yeah. All right.
So
let's get her. By the time this episode comes out, we will put in the show notes, Chloe, a bonus YouTube only episode of me interviewing Amy, who did a career change into financial planning.
Yeah. I think that'd be great.
But yeah, I think
the other thing I wanted to touch on in this question is owning your own business in financial planning. What do you think of that?
Yeah, but that's kind of, we need to work out what we're good at, what we like, what we're suited for. If we are analytical and we just want to do power planning, you could potentially be an outsourced power planner and control your own destiny. If you really like advice, you could potentially start your own advice business one day. I mean, it's not easy.
Yeah.
It's hard, but it's worth it.
The reason for my question is, like, if I was a career changer, because you've got to spend a long time learning the craft. To be a good advisor, you got to be learning the craft. There's a lot of technical skills, a lot of,
procedural
and
skills.
And just like, client empathy, client interactions, like you've got to be great at that. And then becoming a business owner is another big step. And, I'd be interested to know your thoughts of, would you recommend someone do that or start another business? If business ownership was the goal, would you say this is the right path for business ownership?
And this is what I love about the finance industry, or any industry really. Let's just say Chloe was a marketing professional in her current role, worked internally in a marketing team, loved all that, but wants to get into financial advice. Yeah, you could do marketing for financial services and advice and run your own business. You could specialize in doing that for that industry. Likewise, Chloe may love building and construction. She doesn't want to be a plumber, but she could set up a marketing business that focuses on getting plumbers more clients and doing all that. So I think Chloe just needs to work out exactly what she wants to do she could be, and she might have a resolve that, I want to be a face-to-face financial advisor.
Yeah.
If that's the case, run to it, but you need to put in the time. You might take you 5 years to get experienced. You've got to do your time.
Yeah.
You've got to do your time, then start your own business.
Yeah, the only thing I would say, there has been a big trend away from the small business owners in the financial
it's too
advice
hard
space. Yeah,
and expensive.
So that's kind of why I would just say, if running your business is super passionate and what you want, maybe financial advice isn't the thing. If you want to be a great financial advisor, then it's one or the other in my view, because there is a big skew away from the small businesses and it's becoming, big businesses in financial advice.
All right, let's talk about upgrading to a larger PPOR. We'll read Louise's question/comment. My husband and I are working to sell our current PPOR and upgrade to a larger PPOR, which is your principal place of residence, within the next 18 to 24 months. Whilst putting away savings in our offset for this, I'm also salary sacrificing $250 into super and investing another $250 into ETFs per fortnight. So we'll just call it $500 a fortnight-ish that's getting put away for the future. For the next 18 to 24 months, should I stop investing, continue salary sacrificing to super and put that $250 towards a house deposit, or continue investing for our future? Where is that 10 to 13K working better for us? What are you doing, Mr. Philly?
Yeah, I mean, it's a great question, and like I, talked to my wife, when was it, on the weekend, about, well, what should we do? Should we focus on paying off our home loan, or should we focus on building investment? So even as a financial advisor, these are very real questions that we have, because it's the great thing about money is math may tell me one thing, but my emotions or feelings or what I feel comfortable with may tell me another way. So it depends on what's important to you. And actually, I was talking to my good mate on the phone just as you arrived, and he was talking through this. We've got this big amount of money, and should we pay off our home loan? And I just said to him, this is not advice. I said to him, but I said, I know you guys, and I know it's going to be more important that you have a lower home loan than having some money invested, because you'll be tempted to sell those investments in the next 5 years to reduce that home loan.
For those at the back of the room, I'll say it a bit louder. If you just want to pay down your home loan, it's okay. There, I said it. You're allowed to do that. You've just got to make sure, on balance, in your financial life, you're living on less than what you earn and investing the rest. Now, that investing the rest, it could be into super, it could be ETFs, or it could be paying additional payments down onto my mortgage, because I'll save money on interest, I'll pay off the home sooner, then I can swing back around once the house is done and pump the living snot out of super. Yeah. Or investing my own name.
Yeah, and to be very candid, that's the decision me and my wife made, is saying we'll overpay on tax to take profits out of the business to pay down our home loans sooner than we need to, because for us, just we want to, in the short term, not have a mortgage on our home, because running a business, it's high risk, everything can fall to pieces in the future, and we just want to mitigate that risk of having to sell that house. Now, everyone's situation is different. They may not own a business or have that risk, and so they can go, well, actually, we're happy to extend that mortgage out or take the next 15, 20 years to pay it out, as long as we're boosting that super. And so it's really about just understanding yourself and your own kind of, I'm a high-risk human being, but paying off that mortgage and overpaying on tax and financially not being as smart, but emotionally and psychologically being better for us, that's the decision we're going to be making.
I've been watching some YouTube videos lately, and because I like aeroplanes and all that, I was watching this pilot's YouTube, and he's a pilot and all that, and at the end of his, and it just stuck with me, and it has all week, at the end of his video, and this is one for fun, this is one for life, and all this crap that we talk about, you've just talked about the book smart versus the vibe and all that. He says at the end of his videos, remember, superior judgment trumps superior knowledge.
Yeah.
How amazing is that? Like, you could have the best flight knowledge in the world, but when you're up there in that plane, you may have to throw your knowledge out the window, because in this very situation, the judgment, with all my experience, will have a better outcome.
Yeah. And I mean, and we talk about like investing, like one of the worst things about investing for the long term is when life changes and you pull the money out. And that's what I was saying to my friend just on the phone before is I know if the next 12 months the market goes down and you're several $100,000 that you've just sold your old property, if that goes down, I know that's going to crush you way more than the upside of that, the opposite. And so just as a human being, understanding that you may go, well, mathematically it makes sense to invest that money because, the pros and cons, but I know if that money goes down, I am going to freak out and pull the money out and lose any of those long-term benefits. And so for each individual, we've got to really understand, like, try and project forward. Life will always throw curveballs at us and things may change. But understanding yourself is super important when it comes to any of these decisions. Do we clear the debt? Do we put money for salary sacrifice?
I've got the exact answer for this situation.
Yeah.
100% exact answer. She said 18 to 24 months, right? So up to 2 years. That's not a concrete goal. She invests in ETFs. She understands how investments work. What I'm probably doing is pausing salary sacrifice for now putting that money on the offset in June of this year, make a judgment call. Okay, is this happening or not? Yeah, it probably will. Okay, we'll keep it in offset.
And just touch on why you're saying June. What are we deciding?
Because we can effectively now, with salary sacrificing, whether your employer puts the money in and automatically puts it in pre-tax and takes the tax off in the super fund, each year you can put an amount into super up to the 30 grand cap with your own money and claim that on tax and tell your super fund to take the tax out.
Yeah. So that decision in June is, do we salary sacrifice as a lump sum?
Yes.
Yeah, exactly.
And then what I'm probably doing, I'm keeping the ETFs in there, knowing that ordinarily, if we are investing for the long term into ETFs, there will be some fluctuations along the way. But the way I'm kind of seeing this, of that $500 a fortnight, by putting $250 into a growth ETF and putting $250 into an offset account, aka cash, that's a 50-50 split as a very balanced and defensive chunk. So what I'm saying is keep the ETFs going, sure, and then each year make a judgment call. If in 2 years' time it comes along and you've still got money in the offset, you can always put that money into super and use any carry forward, bring forward, whatever the catch-up contributions, there you go, and get it in. So that's probably what I'm doing. Yep. Just pausing the super, being a bit more intentional year on year, and probably still investing, knowing that in 2 years' time, if the market has had a bit of a bath, we either wait 3 or 4 months, see if it recovers before we sell down some shares, or we sell and take the loss because, hey, life's full of risks. Or we go, yeah, we actually can't find a house and it's been 2 years, but now because we can't find the right house, we're going to look for the next 6 months.
Yeah. The only thing I would just say is just know yourself. If you are not going to salary sacrifice that $250 a month, are you spending it? Know your own spending habits. If you're really good at money management, that's a great strategy.
Yeah.
If you're garbage at it and you just go,
get on with your
there's
life.
extra money, then put it in there.
And then I think the question then becomes, because she's talking about upgrading the PPOR, which is probably the more permanent, quote unquote, PPOR, I honestly believe there is a bigger decision that needs to be made once we get settled in that new PPOR with our extra investing and our lifestyle and all our goals and our age and our stage and all that, whether we first cap out our super contributions, then we invest outside in our own name.
Yeah. And that's the only other thing I was going to say is the investing, knowing what that deposit requirement will be.
Yeah, you should be able to project.
Because if I know that I will need to sell all of those ETFs to afford this house deposit, then I personally wouldn't be putting money in the ETF. If I know that, hey, that ETF portfolio, that's an optional sell. If we really need it because we really want this bigger house and we're not going to spend LMI, like lender's mortgage insurance, to get there, then let's sell that portfolio.
Yeah. And I would assume that, oh gosh, far out. This is the crazy thing in these scenarios. When you really look at it, potentially it would make more sense if you are investing in your own name, put as much into the house than if you still want to invest, redraw and have a investment split of 100, 200 grand or whatever that is, and at least that portion of the debt is deductible.
Well, that's exactly the phone call I had that I didn't give him financial advice, but I was saying, I know you as people, you want your mortgage to be low. And if you do say you want $100,000 to invest in the market, don't take your cash that you've just used from your property to invest in cash. Put it all off your mortgage and then redraw
because
against
I
the
think
property.
The more I think about it, absolutely pause super for now. Maybe just keep investing in your own name if you understand the risks and all that. But then once we come to go time or hammer time, we go, okay, this house is worth this much. We've got $100 grand share portfolio here. We're going to sell down the share portfolio, pay a bit of tax on it. We're going to put everything we've got into the new house to have a lesser mortgage. Then once we settle, get all the costs worked and all that, we go, okay, what's important? Continue to smash the mortgage, or no, we want some gearing into equities. Well, let's get a split on the house and then invest.
Yeah, and talk to a great broker at the start when you're moving to that new PPR to go, do we structure it that way now?
And I don't think it's a tax wash or anything illegal or dodgy, because legitimately at the time you were putting that money into buying your new house.
That's right.
And I'm not suggesting we're doing it the next day. I'm suggesting we get settled. Look, if it's a bigger house, you might need to spend an extra $100 on the lawn person or something, or more insurance. Then when your budget is settled and you know how much it's going to cost to be in that house, and if we do a mortgage split and invest that into equities, then we can go, okay, how much can we actually service? Because if you do a split to invest into shares or investment properties, the investment property has income, the shares have dividends or distributions, there is still usually a hole that you need to plug out of your own cash flow. All right, see you, Phil.
Thanks for having me. Appreciate it. Thanks for coming.
Where can people find you? Who cares? Whatever.
Go to the website.
Yeah, go to the website.
Yeah.
Is it Sky Wealth or sky.com.au?
Just Sky, skye.com.au.
Yeah, right. Hey, thanks so much for listening today, everyone. Bye.
See ya.
Thanks for listening to today's podcast. If you want to support us, there is one way you can do that. You can send the episode to a friend, a family member, or your group chat if you think those people would find it valuable. We also thank you for leaving a review on Apple or Spotify. If you've listened to this podcast for some time, or if you've read any of my books, you would know that giving and generosity in a financial sense is a big thing in my life. If you think it's time that you are ready to give financially to a good cause, you could head to our website, moneypodcast.com.au/charities, to see the charities that we support.
Any advice is general financial advice only, which does not take into account your objectives, financial situation, or needs. Because of that, you should consider if the advice is appropriate to you and your needs before acting on the information. If you do choose to buy a financial product, read the Product Disclosure Statement, PDS, and Target Market Determination, TMD, and obtain appropriate financial advice tailored to your needs. Simo Interactive Pty Ltd, the publisher of this podcast, and Glen James are authorised representatives of Money Sherpa Pty Ltd, which holds Financial Services License 451289. Opinions or comments from any guests on the podcast are theirs and not those of the host or the publisher or their respective license holders.